Hello, this is Jeff Haig again, and this video that I'm recording and that you're watching right now is for Chapter 11 of our textbook. Chapter 11, called Property Dispositions, basically is broken into two parts. The first part of the chapter deals with when a property is disposed of, whether it's sold. In these cases, when it's sold, the taxpayer has to determine how to treat the gain or the loss of the property. The second part of the chapter talks about non-taxable transactions, with the focus being on the like-kind exchange. So we'll look at both of those, of course, and several other things as we go through this chapter. So when you're watching my video, I would suggest that you print out a few things that I have posted. One of them is the Excel spreadsheet that I created that helps you determine what the gain is, what the basis is when there is a like-kind exchange. So print out that Excel spreadsheet, and we'll talk about how that works. And then I also posted two other items. An example of Form 4797, which shows when business property is sold, and then Form 6252, there's so many forms out there, Form 6252, which shows how an installment sale is reported. So let's skim through the chapter and we'll see what else is out there. And I hope this video will help you understand this chapter. So as I have indicated in my postings about Chapter 11, is that you are only supposed to read objectives 1, 2, 3, and 6. You can read 4 and 5 if you want to, but we're just going to concentrate on objectives 1, 2, 3, and 6. Basically, objective 1 talks about what a disposition is of property. And this chapter just covers the dispositions of business property, whether it's a piece of equipment or a warehouse or a rental house. It's just business property. Earlier chapters, we talked about when a taxpayer loses an item, meaning it's been stolen or it's been destroyed in a car accident. That is personal property. This chapter talks about business property. All right? So, objective 1 looks at the disposition of a property. Page 11-2 has a term there, amount realized. When something happens, when property is disposed of, and in many of the cases in the book, the property is sold, there's an amount that the taxpayer realizes. All right? Doesn't mean it's being taxable or being paid tax on. It's amount realized. 11-3, what is the adjusted basis? Usually the basis of business property is what the taxpayer paid for it. Okay, how much he or she paid for it helps determine what the basis is. They talk about gifts here. They talk about inherited property. They talk about property converted from personal use to business use. So sometimes those things happen. Page 4, 11-4, gives you quite a few examples of what the basis is in different, how property is acquired by the taxpayer. The important thing to look at on 11-3 is when personal property is converted into business property. This happens a lot when someone has a house, buys another house, keeps that first house that was their primary residence, and turns it into a rental property, which means they're turning it into business property. The taxpayer would love to take the current market value of that property and turn that into business property, because then it could take a lot more depreciation. But the tax law says it can only be what the taxpayer paid for it, which will be used for the basis for depreciation, or what the market value is of that property. So the market value is lower at the time of conversion to business property. That is what the taxpayer has to take, not how much they paid for it. So that could really lower how much depreciation can be taken each year on that rental property. Page -5, the adjusted basis. In most cases, as it states on top of page -5, the adjusted basis is the initial basis less the cost recovery, allowed or allowable. Cost recovery is just depreciation. Because remember, I cannot expense an asset completely in 1 year. Some cases I can, but in most cases I can't. So whatever I can't expense in that year of purchase or that year of using that asset, I get that cost back or recover that cost by depreciation. So I pay for an asset, say I pay $100 for an asset, I take $30 worth of depreciation over 3 years. After those 3 years, my adjusted basis is now $70. Once again, I pay $100 for an asset. It's a business asset. I can depreciate it. I depreciate $10 per year. After 3 years, I've depreciated $30 worth. So the basis is now, the adjusted basis is now $70. $100 less $30 of depreciation, $70 basis. That's the basis I'm going to use when I sell the asset, or it gets stolen, or it gets destroyed. But most of our cases in this chapter is when I sell the asset. All right. Now, notice this on 11-5. It says cost recovery, allowed or allowable, meaning the depreciation I could have taken based on the tax law. This means that if a taxpayer forgets to depreciate an asset and forgets to claim that depreciation, the IRS doesn't care. When it's sold, it's still treated as if that depreciation was taken. All right? So that's important. It's important to make sure that everyone takes the depreciation they're entitled to. All right. Going on, example 11-3, example 11-4, it shows us how gains are treated. Realized gain or loss on disposition. That's our first step, what's realized. Our second step is what is recognized. Write those two words down, realized gain and recognized gain. If you look in the dictionary, realized comes first, then recognized comes second in the order alphabetically in the dictionary. So this helps you determine that the first step you do is determine the realized gain. How much is realized by the taxpayer? The second step on page 6 is the recognized gain, meaning whatever is recognized on the tax return, that's what's taxable. That's what gets applied with whatever tax rate that gain has applied to it. That's the recognized. So remember, realized gain calculated first, recognized gain calculated second. Exhibit 11-2 shows the sale of 5 different pieces of business property, land, truck, warehouse. That exhibit 11-2 is shown in several examples going through the chapter, and it's shown how it's reported on form 4797 on page 11-21. All right? So right below exhibit 11-2 is our term for recognized gain or loss. Okay? Now 11-2 is where we start talking about the character of gain or loss. The character of it, how it's treated, how it's taxed. 11-7, page 11-7. Ordinary assets. Okay? Ordinary assets, they give examples here. Inventory, that's an ordinary asset. Because if I sell inventory, it's going to give me income that is ordinary, meaning that's what I do all the time. It's ordinary income. So it's taxed at whatever my ordinary tax rate is. Capital assets, we talked about capital assets earlier in the chapter in the class. Usually it's stock for an individual, or their house, or their car. Okay? So those are usually items held for investment. So you want to know those two things: ordinary assets, capital assets, and then 11-8 introduces us to a new asset, what they call Section 1231 assets. Now, if you've taken business law, you talk about sections of the law there. This is a code section. This is the law. Same as several things of business law or federal law. This is a section of the federal law for the Internal Revenue Code. 1231 assets. 1231 assets, I'm just going to read from the book. 1231 assets are depreciable assets and land, because remember, land's not depreciable, but depreciable assets or land that are used in a trade or business, including rental property, held by a taxpayer for more than 1 year. That's 1231 assets. So now we have three different assets. We've talked about capital assets a few chapters ago. So we have capital assets, we have ordinary assets, we have 1231 assets. Capital assets, my house, my stocks, my jewelry, my bonds, my investments. Capital assets. Ordinary assets, inventory, usually in most cases, because when I sell inventory, I get ordinary income. Then 1231 assets. 1231 assets are business assets that I've held for a year or longer, and they're depreciable. So business assets, assets I've used for rental property, that's what 1231 assets are. Okay? So make sure you write down those three types of different assets, because I'm sure I'm going to have that on the quiz. Okay? And those are discussion questions also. Depreciation recapture, page 11-9, learning objective 3. Depreciation recapture. Remember what depreciation is. Depreciation is the recapture of the cost of an asset. That asset I talked about a few minutes ago, it was $100. You wrote this in your notes. It was $100. I recovered $30 of it through depreciation. So now after 3 years of depreciation, the basis is now $70. Now that $30 that I took as depreciation on my tax return helped lower my ordinary income. If that $100 asset was used in my small business, so on Schedule C, I would have shown $30, well, $10 each year of depreciation. That would lower my ordinary income by $10 each year. So over 3 years, first year $10, second year $10, third year $10. Over 3 years, I depreciated $30. That $30 lowered my income, ordinary income, $10 each year. Okay? So that was a benefit to me. It lowered my ordinary income. It made my ordinary income $30 less over those 3 years. $10 each year, but over the whole 3 years, $30. That was a benefit to me. Even though I paid $100 for the asset, I got a benefit each year of $10 less ordinary income because of that $10 depreciation. So, when I sell the asset, say I sell for a gain, some of that gain is going to be recaptured because I took depreciation in those 3 years. So when I sell the asset in year 4, I'm going to have to recapture some of that gain as ordinary income because I had the benefit of that depreciation against ordinary income over 3 years. Now this will be easier to understand when we look at the 4797 that I posted and that you printed out from Blackboard. So that's my depreciation recapture. And it happens when I sell a 1231 asset at a gain. Some of that gain will be recaptured as depreciation recaptured and taxed at my ordinary tax rate. Because think of this, that depreciation I took lowered my ordinary income, so I paid less ordinary tax. When I sell that asset later, in year 4, let's say, when I sell it for more than the adjusted basis, some of that gain, maybe all that gain, will be taxed as ordinary income as depreciation recapture. If you look on page 10, see where it says 1245 property? That's, in the cases we're looking at, when I sell personal property. Personal property used in business, such as equipment, machines, trucks, a car, a computer, that's 1245 property. And if I have a gain, may be recaptured and taxed at ordinary tax rates. Okay? Not going to go through an example yet because we have an example to show later on as we go through the chapter. Okay? So page 11-11 talks about the gain created solely through cost recovery deductions. Okay? So read that example, 11-6. The next example, the gain, some of the gains due to cost recovery, meaning some depreciation I took, and asset appreciation. I sold the asset above what it cost me. So some of my gain is depreciation recapture. Some of it's going to be taxed at the 1231 gain because it appreciated in value. Then scenario number 3 on page 11-12, I sell the asset at a loss. Okay, there's no gain to look at, but the loss will reduce my ordinary income. Now let's look at Exhibit 11-6, because right now you stop the video, you review these examples, example 6, example 7, example 8. You've looked at those examples. So now you're starting the video again, and you're looking at Exhibit 11-6 on page 11-13. Here's my 3 scenarios of those examples in this chart right here. Now, reading this exhibit, 11-6, let's look at the first column on your left-hand side. Okay, it's just showing us in blue and in gray or brown or tan what 2 things we have here. Blue is the adjusted basis. What the basis is of the property, my cost less my depreciation, that's my basis. The tan part is the depreciation that I've taken, and some of that, if I sell for a gain, some of that depreciation will be taxable as ordinary income. Let's look at my first example here. Okay, I sell it for $200,000. That's what I realize from the transaction. Okay, and my adjusted basis is $191,173. My cost, $510,000. I paid $510,000 for this asset. I depreciated over several years. with that cost recovery, with that depreciation, the new adjusted basis is $191,173. I sell this asset for $200,000. That covers all my adjusted basis of $191,173, but it goes over a little bit, as you see there in that second column from the left. My ordinary income, my 1245 income of $8,827. If you add up 8,827, do this. If you add up 8,827 plus 191,173, you will get 200,000. All right, the amount I realized. So some of that didn't, some of that 200,000 covered my adjusted basis, and the rest of it, 8,827 of it, went above my adjusted basis. That's a gain. It's ordinary income of 1245. So I'm going to have to treat that as 1245 as ordinary income, as you see there in the exhibit, in that second column from the left. Now another scenario, the other example we looked at, I sold this property. This is example 11-7. I sold this property for $520,000, more than my adjusted basis and more than what I paid for it several years ago. So that $520,000 covers all my adjusted basis up to $191,173, and then there's a lot of ordinary income, $318,827 of ordinary income, because that covers all the depreciation I took over the years that I took on this asset, covers all that. That's taxed as ordinary income. And then the $10,000 above my cost, because I sold it for $520,000, it cost me $510,000. That $10,000 gets treated as a 1231 gain and gets treated at a lower tax rate, which I like. Okay. Some of the gains taxed as ordinary income, meaning whatever my ordinary tax rate is, 39%, 25%, that's what that $318,827 will be taxed at. But then 10,000 gets the benefit, that will be taxed at like a capital gains tax rate, which could be 10%, 15%, something lower than my ordinary rate. So let's look at my last scenario, which is example 11-8. I sell this asset for only $180,000, not only below the cost of it, but below the adjusted basis of it. So I have a loss of $11,173. That loss will be reported against my ordinary income. So reduce my ordinary income, which I like. And then I got $180,000, but I have a loss of $11,173. Okay? So if you look at these three scenarios, depending how much I sell my asset for, how the income or the gain, the gain or the loss gets treated depends on how much I sold it for and how much depreciation I could have taken. Doesn't matter if I never took depreciation. The IRS says whatever depreciation was allowed or allowable, that's what will be calculated when you sell the asset. So even if a taxpayer did not take any depreciation, depreciation that could have been taken will be part of the recapture if they sell it at a gain. Now look at this $520,000 sale price, our example number 7. A lot of the ordinary income of $318,000 gets treated at ordinary tax rates, but then some of the gain gets treated at the beneficial rate, the $10,000. So we like that. Okay. Look at the loss here. Because it's a 1231 asset, the loss of $11,173 reduces my ordinary income, which I like. Okay. So I might get the best of both worlds in some cases. Okay? It depends how much depreciation I've taken. The best of both worlds, that's a discussion question. So you'll figure that out as we go on here. Okay? All right. 1250 at the bottom, section 1250 at the bottom of page 13. Just read that. 1250 refers to depreciation recapture on real property. Real property, rental property, warehouse, office building, factory, airplane hangar, real property in the ground, section 1250. Okay? All right. After example 11-10, you skip this objective 11-4. Okay? We don't go into this. 11-5, we don't go into this. Calculating net 1231 gain or losses. Okay? It's very complicated. All right. If you go to page 11-20 now, okay, you see exhibit 11-9. This exhibit 11-9 is reported on the 4797 on page 21 and 22. Okay? So you can follow that exhibit here based on the information they give you in exhibit 11-9, how to report all these items and how the depreciation is recaptured from when an asset is sold. And we're also going to look at the 4797 that I posted under the chapter 11 section that you printed out. It's from another textbook, but it gives a simple example of how this 4797 works. Okay? Well, why don't we look at that 4797 since we're right here? Okay? If you look at this 4797 that I put in the chapter 11 section, okay, it's a PDF. If you look at the first page, there's an arrow here that tells you about what is going to be reported on this 4797 on the next few pages of that PDF that I posted. Okay? Basically, it's explaining what has gone on. Okay? We're going to go to the third page of that scan, which is page 2 of the 4797, which is part 3, page 2 of the 4797. Okay? Part 3, page 2 of the 4797. If you look at the top of page of line 19, it says equipment. When I bought it and when I sold it. Let's see, I've had this equipment for more than a year, so it's going to be section 1231 property because I use it in my trade or business, and it's depreciable, and I've had it for longer than a year. If you go to line 20, I sold it for $60,000. If you go to line 21, $58,000 is how much I paid for that asset several years ago. Well, in this case, just about 2 years ago. Okay? Line 22, depreciation allowed or allowable. Doesn't mean if I took it or not. That's just saying what I could have taken for having this equipment for 2 years. That's $27,565. Okay? 58,000 less 27,565 gives me my adjusted basis of line 23 of 30,435. That's my adjusted basis, okay, which we saw that term before. Total gain, line 24, basically is line 23 or line 23 from line 20. What my sales price is, $60,000 less 30,435 gives me my total gain, 29,565. That's my total gain. Okay? I sold this asset above what I paid for it. I paid $58,000 for it. I sold it for $60,000. So let's go to line 25. if Section 1245 property, which it is because it's used in a trade or business, it's equipment, and it was depreciated, or it could have been depreciated, that means that 29,565, 27,565 of it is going to be recaptured as 1245 property. Okay? See line 22? That's how much depreciation I took. Line 25A, that's how much of that depreciation I'm going to recapture and treat as an ordinary gain. Okay? Line 25B, 27,565. Well, what about that $2,000 difference between 29,565 and 27,565? That 2,000 is above what I paid for the asset. I sold it for 60,000. I paid 58,000 for it, so it went up in value. That $2,000, part of that total gain, that 2,000 is going to go down below the line 32. If you look on that page, line 32. So my total gain is 29,565. 27,565 of it is going to be taxed at an ordinary rate because it's recapturing that depreciation that I took that reduced my ordinary income over the last couple years. That 2,000 is going to be taxed at a lower rate, like the capital gain rate. All right? Let's go to page 1 of the 4797. Okay, 4797, sale of business property. Look at line 6. There's my $2,000. Go to line 7. There's my $2,000. See where it says individuals in that big paragraph to the left under line 7? Basically, it says it's going to be reported on Schedule D. Schedule D is the sale of capital assets. Most people use that to report sale of their stock. When they sell stock, it gets reported on Schedule D. So this $2,000 is going to go on Schedule D, and it's going to be taxed at my capital gains rate, which could be 10% or 15% in most cases. Still looking at page 1 of the 4797, see line 13? There's my gain, 27,565. It goes down to line 18B, okay, just flows down there. That goes on the front of Form 1040, line 14. The front of Form 1040, line 14, all my ordinary income, okay? My ordinary income, that 27,565 will get taxed at the ordinary rate that I'm being taxed at in that year. And that could be as high as 39.5%. So, not as good as the capital gains rate. All right? So that explains the 4797 that I posted in the class website, okay, on Blackboard. All right? So read that, read where the arrows start, and go reporting casualty or gain or theft of Form 4684 also, okay? And that'll help you understand the 4797. It will help you understand how it's working in the book. So read this one first, look at this one first that I posted, then go to the chapter one, because the chapter one has several assets going on, okay? All right, let's continue. The next big part of this chapter is the non-recognitions transactions, and that's learning objective number 6. Basically, this deals with like-kind exchanges, or as a lot of people call it, Section 1031. And that's the code section that talks about the like-kind exchanges. If you talk to a realtor or someone who owns rental houses or a property developer, they'll know what 1031 is, because it's when one piece of business property can be exchanged for another piece of business property and nothing is recognized. No gain, no loss. non-recognition transaction. Usually happens when someone takes a rental property, like a rental house, and exchanges it for another rental property. Okay? Now, it can only be a car for a car, business, of course, a truck for a truck, an airplane for an airplane, office building for an office building. Some cases it can be a building for a piece of land. Okay? So it really has to be real property for real property, personal property for personal property. Okay? It can't be a cow for a bull because a cow does something different than a bull. Can't be a chicken for a rooster because they each do different things. Okay? I know that's a weird way to look at it, but that's what it is. Like kind business property. Trade for one, the person gets a new piece of property. Okay? Now, this is talked about on page 24, page 25, what it is, how it's used, the timing requirements on page 25. Usually when people exchange pieces of property, they use a third party, someone who's going to help them do it, because if they miss the deadlines, if they miss the time period, that transaction is a disposition now, and whatever happens, it's treated like it was sold. The gain or the loss gets recognized. The reason why I do these transactions, or people do these transactions, is not to recognize the gain that's sitting there. Okay? See, for instance, someone has a rental property they've had for 30 years. They don't want to recognize the gain, but they want to sell it, but they don't want to recognize the gain. They'll exchange it for rental property somewhere else, in another part of the country perhaps. Okay? Maybe they have a piece of property on the beach. They want to trade it for a piece of property on a golf course. Okay? They don't want to recognize the gain that's sitting in that property, so they do a like-kind exchange. And like I said, usually it's with a third party that helps them do it. Okay? Page 26 shows the Starker exchange, how a third party helps with this transaction. Okay? Page 27, tax consequences. Okay? The new property they get may have a different basis than the property they gave up, but in most cases the basis stays the same with the property they get. They just keep using that basis that they gave up. They start with the same basis and go forward. See where the term boot is mentioned on page 27? That's basically cash or other equipment that the person receives when they're exchanging property. Think of it like this. Someone is exchanging a piece of property, they're not going to accept anything less than what the market value is of that property they're getting or giving up. Okay? They're not going to accept anything less. So if they're exchanging their property, they're giving up their property, and the property they're getting doesn't meet the fair market value of what they're giving up, they're probably going to want some more stuff. So the person on the other side of the transaction may have to give them something more, meaning I will do this transaction, or I'll give you this property, but I'll give you some cash to boot. I'll bring it equal between each other. So boot in all cases is cash, which that's not an asset. I mean, it's an asset, but it's not part of the transaction, or not the property being transacted or exchanged. Or it could be other equipment or another item. Okay? And the examples I'll post, they give an example or two of that where someone gives up a piece of equipment, but in return they get some cash and maybe some other property just to make the transaction be fair for both sides. Okay, that's what boot means. So they go through this on page 28 and 29, and you can put these numbers into that Excel spreadsheet that I put up there and make it work, and it should come up with the same basis, adjusted basis, or gain realized or gain recognized based on these examples 16 and 17. Okay? Reporting the like-kind exchange, that uses form 8824. and I believe I posted a link to that, but that's on the irs.gov, Form 8824. Okay, it goes basically through the same calculations on the second page of that form, goes through the same calculations that the Excel spreadsheet does. Okay, so like I said, use that Excel spreadsheet to help you with these examples 16 and 17. And also look on page 30 of the chapter. There's my part 3, page 2, part 3 of Form 8824. And there are the amounts put in those lines. Okay? Involuntary conversions, page 29 at the bottom. That means, now I have an example of that example I'm going to post, or is posted, of involuntary conversion, meaning someone had a piece of business property, it was stolen, or it got destroyed, then they get insurance reimbursement. They may have realized some gain, but if they invested in another piece of property right away, they won't have to recognize anything. So once again, I go through my steps. My property has a cost. My property now has an adjusted basis. The government takes my property, or a fire happens to my property. I get reimbursed by the insurance company. I may have a realized gain, but I invest it right away in a similar property. I won't have a recognized gain. Okay? So they talk about that. They talk about on page 30 and page 31 what the time periods are and so forth. Because if they don't do it within a certain time period, it'll all become recognized gain. All right? So look on the examples on there. On this example that they have on page 18, okay, it goes to, I'm sorry, example 18 goes from page 31 to page 32. Okay. Installment sales. I posted an example of installment sale that gets reported on form 6252. Okay. 6252. There's an example on this PDF I posted. Example 23. You want to look at that example. On the second page of the PDF I posted, the example 23 gets worked out. And then at the last page of the PDF, the example is shown on my installment sale, the installment sale form. Basically, an installment sale is when someone sells a piece of property, let's say, and they get cash payments over time, over the next several years. It's an installment. So every cash payment they get in the years to come, some of that cash payment will be claimed as income based on what the profit was from the sale when it happened. So every year they get, let's say, $10,000 of cash. Only a part of that is taxable because that is part of the gross profit from the sale of the property. So like I said, look at my example on the 6252 of how they determine the gross profit, okay? And whatever the gross profit is, that percentage gets treated as income every year. So if someone gets $10,000 every year and the gross profit was 50% from the sale several years ago, of that $10,000, only 50% or $5,000 is treated as income in that year. All right? And so they talk about this. They give an example, example number 19, okay, on page 33. They show how this operates, okay. Page 34, they talk about gains that are not eligible for installment reporting, okay. Usually it's stock, okay, or inventory. They can't use the installment method, okay. They have to recognize the gain from the transaction right away, not over several years. Then the last page of the chapter, page 35, looks at related person loss disallowance rules. Code section 267 basically says if there's a loss and the transaction was between related people, okay, usually father or mother, child, son or daughter, okay, aunt or uncle, um, that will not be allowed, okay? Includes siblings, spouses, ancestors, grandparents, and linear descendants, okay? Sons and daughters, okay? So if that goes through or a transaction happens between related parties, the IRS will disallow that loss, okay? That loss gets not recognized. It may get realized, but it won't get recognized. Once that person who has the property now sells it to an individual not related to anyone, then the loss can be recognized at that time. Okay? So just the IRS, Congress, not allowing losses between related parties. Okay? Gains between related parties, of course, gains will be taxable, realized, then perhaps recognized, gains right away. But losses, no. All right. So, read the summary, of course, before you read the chapter. Here are good discussion questions. Question 1, question 2, 3, 4, 5, 6, 7. 1 through 7 are good. Also, questions 10 and 11, 13 and 15, 24 through 31. Okay? All these questions are good to think about. What these transactions are, and some of these questions, are they good? Can they be changed? What would you do differently to make them work? Okay? Because the goal is, as we said before, is that I should not pay any more tax, working with the law, not pay any more tax that I'm supposed to pay. All right? If I don't want to recognize a gain, maybe I should do a Section 1031 transaction. If I do sell an asset, okay, I want to treat the gain properly. Some of that gain may be taxable as depreciation recapture. So I may be taxed at an ordinary rate. Some of the gain above that will be taxed at a capital gains rate. All right? So these things are important to understand. I know this chapter is difficult, okay? But take it from me. Of course, I've talked about this a lot. I remember when I started working at my CPA firm at Price Waterhouse, which is now Price Waterhouse Coopers. About 2 months into my job, I had to do a presentation on this to all the other people at my level. Some of them were staff like me, some of them were seniors, and of course, a partner was there. But I had to talk about this 1231 assets and this depreciation recapture as 1245. All right? So it is difficult. But hopefully watching my discussion here, hopefully going through the examples I posted, going through using that Excel spreadsheet for the 1031 transaction, going through all of these examples will help you understand how to deal with this. Thank you.